As mentioned briefly in the previous video, when a company buys an asset that will probably last for greater than 1 year, the cost of that asset is not counted as an immediate expense. Rather, the cost is spread out over several years through a process known as depreciation. The most basic form of depreciation is known as straight line depreciation. Using this method, the cost of an asset is spread out evenly over the expected life of an asset. For example, Daniel spends $5,000 on a new piece of equipment for his carpentry business. He expects the equipment to last about 5 years, by which point it will likely be no substantial value. Each year, 1,000 of the equipment's cost will be counted as an expense. When Daniel first purchased equipment, he should make this journal entry. Then each year, Daniel will make this entry to record depreciation expense for the equipment. Accumulating depreciation is what's known as contra account, or more specifically, a contra asset account. Contra account are used to offset other account. In this case, accumulated depreciation is used to offset equipment. At any given point, the net of the debit balance in equipment and the credit balance in accumulated depreciation gives us the net equipment balance, sometimes referred as the net book value. In the example we just talked about, after the first year of depreciation expense, we would say that equipment has a net book value of $4,000, since $5,000 is original cost minus $1,000 accumulated depreciation. We make the credit entries to accumulated depreciation rather than directly to equipment, so that we have a record of how much asset originally costs and have a record of how much depreciation have been charged against the asset already. Now, here's a continued version of that example. Eventually, after 5 years, accumulated depreciation will have a credit balance of $5,000. And the asset will have a net book value of 0. When Daniel deposes the asset, he will make this entry. After making this entry, there will no longer be any balance in equipment or accumulated depreciation. What if a business plan used an asset for a few years and then sell it before it becomes entirely worthless? In this case, we use what's called a salvage value. Salvage value, it's a value that the asset is expected to have after that planned number of years of use. For example, Lydia spends $11,000 on office furniture, which she plans to use for the next 10 years, after which she believes it will have a value of approximately $2,000. The furniture's original cost minus the expected salvage value is known as the depreciable cost, in this case $9,000. Each year, Lydia will record 900 of depreciation like this. After 10 years, accumulated depreciation will have a 9,000 credit balance. If at that point Lydia does in fact sell the furniture for $2,000, she'll need to record the inflow of cash and write off the office furniture and accumulated depreciation balance. Of course, it's pretty unlikely that somebody can predict exactly when an average salvage value will be several years from the day she bought the asset. When the asset is sold, if the amount of cash received is greater than the asset net book value, a gain must be recorded on the sale. Gains work like revenue in that they have credit balance and increase owner's equity. If, however, the asset is sold for less than its net book value, a loss must be recorded. Losses work like expense. They have debit balance and they decrease owner's equity. Determining whether to make a gain entry or loss entry is never too difficult. Just figure out whether an additional debit or credit is needed to make the journal entry balance. For example, if after 10 years, Lydia has sold the furniture for $3,000 rather than $2,000, she will record the transaction like this. And if, however, Lydia has sold furniture for only $500, she will make this following entry. In addition to straight line, there are a handful other and more complicated methods of depreciation that GAAP also approve. For example, the double declining balance method consists of multiplying the remaining net book value by a given percentage every year. The percentage used is equal to double the percentage that would be used in the first year of straight line depreciation. For example, Randy purchased $10,000 of equipment which he plans to depreciate over 5 years. Using straight line, Randy would be depreciation 20% of the value in the first year. Therefore, the double decline balance method will use 40% depreciation every year, 2 times 20%. The depreciation for each of the first 4 years would be like this. Because equipment is being depreciated over 5 years, Randy will record 1,296. That is 2,160 minus 864 of depreciation expense in the 5th year in order to reduce the asset's net book value to 0. Another GAAP accepted method of depreciation is the unit of production method. Under the unit of production method, the rate at which an asset is depreciated is not a function of time, but rather a function of how much the asset is used. For example, Bruce runs a business making leather jacket. He spends $50,000 on a piece of equipment that is expected to last through the production of 5,000 jackets. Using the unit of production method of depreciation, Bruce will depreciate the equipment each period based upon how much jacket were produced at a rate of $10 depreciation per jacket. If in a given month, Bruce's business uses equipment to produce 150 jackets, this entry will be used to record depreciation. The concept of materiality plays a big role in how some assets are accounted for. For example, consider the case of a $15 wastebasket. Given the fact that wastebasket is almost certain to last for greater than 1 year, it should theoretically to be depreciated over its expected useful life. However, in terms of the impact on the company's financial statement, the difference between depreciating the wastebasket and expensing the entire cost right away is clearly neglectable. The benefit of the additional accounting accuracy is far outweighed by the hassle involved in making insignificant depreciation journal entry year after year. As a result, assets of this nature are generally expensed immediately upon purchase rather than depreciated over multiple years. Such a purchase would be ordinary and recorded like this. So, a quick summary. Straight line depreciation is the simplest depreciation method. Using straight line, an asset cost is depreciated over its expected useful life, with an equal amount of depreciation being recorded each month. Accumulated depreciation, a contra asset account, is used to keep track of how much depreciation has been recorded against an asset so far. An asset's net book value is equal to its original cost, less the amount of accumulated depreciation that has been recorded against the asset. If an asset is sold for more than its net book value, a gain must be recorded. If sold for less than the net book value, a loss is recorded. Immaterial asset purchase tend to be expensed immediately rather than being depreciated.